if you're listening to this call and it's all in you and you're worried, then you've got too much risk, and you should basically de-risk yourself. What is the worst that could happen in a de-risking of yourself? You lose an opportunity in the middle of World War III, in the middle of a lockdown in China, in the middle of the highest inflation rate in 40 years. Yeah, I should have been loading up on risk at that point. If that's not your call, then de-risk and ride this out and wait for a time that you better understand the market.
Thanks for joining us for part 2 of our interview with market researcher Jim Bianco. If you haven't yet watched part 1 of our discussion with Jim, in which he underscores the unwinnable choice the Federal Reserve faces right now, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Jim and I, as well as our partners at New Harbor Financial, share in this video. And please take just a moment to support this channel by first liking this video and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Doing so will help this video reach a lot more viewers. All right, let's get started watching part 2 of our interview with Jim Bianco. How does somebody go about allocating capital in this type of environment? What sectors, what potential asset classes are you looking at right now as places where, the type of people who are watching this video, the average investor who's first and foremost just doesn't want to become collateral damage to all this, but also ideally, wants to chart some sort of profitable long-term course out of this?
So the thing that's working right now is the inflation trade. The warning with the inflation trade is twofold. It is extraordinarily volatile to own stuff that would benefit from inflation. What I mean by that is whether you're talking about commodities or energy stocks or basic material stocks, industrial stocks, and the miners, and the like. Or as my friend Dennis Gartman likes to say, if you could drop it on your toe, buy it. And so that stuff has been working with a tremendous amount of volatility. Now, the warning there is that, without getting too deep into the weeds, I'll just say this at a top level. There's some real problems in the commodity trading venue. Commodity traders are losing money. They're getting posted with big margin calls. Exchanges like the LME are closing trading in things like nickel. So there's problems all over the place. Yesterday, incredibly, there's an energy trading association, a worldwide energy trading association. They actually called on central banks to bail them out because they're in such a bad place right now, the energy traders, with that wild run up to $140 in crude oil and then back down to 95 in 8 days. It's really taken a huge toll on them. And today, President Macron of France came out and said they might have to nationalize some of the energy companies in France because they've lost so much money in the last couple of weeks. So if you're going to play the commodity play, all I wanted to say there is you're going to see cryptocurrency type of volatility in those plays. I still think they're going to work because I don't think that the inflation story's done yet, but it isn't going to be an easy ride. Now, after that, and that applies for gold and that applies for everything else that you would lump into that big category of commodities. Now, after that, if you're talking about more traditional investments, yes, consumer discretionaries and healthcare will probably be good places to put your money because, I don't care what the state of the economy is. I still need Procter & Gamble to make toothpaste, and I'm still going to require the services of a doctor. But in this environment, that might be managing losses. Yeah, they'll outperform, but they might outperform in a declining market as well too. The problem with financials is higher interest rates and an inverted yield curve are not good for financials, and they've been suffering from that as well too. So what I'm trying to say is there's not a lot of good options out there other than somewhat of a defensive crouch, that short-term debt, which matures. I'm talking about high quality treasury debt and stuff, which matures and is going to give you a higher yield pretty much every 6 weeks because the Fed is going to be raising rates. It's not going to give you a positive after inflation return, because if you can find something that's going to give you 8% just to break even on inflation, good luck to you. It's going to be, that's a very, very tall order. There are some Series E inflation bonds that the Treasury, savings bonds that the Treasury issues, that will pay you the inflation rate as a coupon, but you're only limited to $10,000 per person per year. So, those are, me and my wife buy them every year, our allotted amount is those, but that's only $20,000 for two people per year as well too. So these are kind of some of the ideas that you want to look at. Other than that, I think it is a defensive crouch, and the idea is to just not wind up in a hole if, as this thing plays itself out, and maybe when the skies start to clear, you've got the ability to get back into the market, because there's a lot of things that are really working against the market right now. The last thought I'd give you is another sign that things are difficult. I'm going to put my old technical analysis hat on. If you look over at the market now, like the S&P 500 or the NASDAQ composite, we all of a sudden are not getting exercised by 2% days. Boy, there was like one of those last year. But when you get tremendous volatility, and like we had yesterday, the day we're recording, the day that the Fed announced its rate hike, the S&P was up 2%, went down on the day, finished up 2%. That's extraordinary volatility. It usually only happens in a bear market. It's very, very rare to see bull markets have that kind of whipsaw kind of action. That's a hallmark of a market that is probably still in a downtrend. So yeah, I am, Johnny Raincloud here. And other than commodities, but if you want to play commodities or the inflation beneficiary play, yeah, you might have a 10% day up and down. And you want to structure any kind of investment with the idea that if it winds up going against you 10% in a day or 15% in 2 days, that you're not freaking out by those kind of losses. If you are, you've got too much of a position in it. But I do think that if you can stomach that kind of volatility by just having a smaller position in it, so that it's a small loss in your overall portfolio, I think you'll still wind up being happy you did it by, say, the end of the year.
All right, great. Hey, thanks for going through such a detailed list there. To your last point about the volatility in the market, the guys from New Harbor Financial, one of the endorsed financial advisors that Wealthion refers people to, they're going to be coming on after this conversation. And you kind of just gave them sort of a great commercial for why a lot of people who are sort of regular investors probably should work under the guidance of a professional financial advisor to both figure out how to do an allocation for this type of environment, but to also take a lot of the emotion out of the decision making, because as you rightly said, and I've talked about with them a lot in this program, oftentimes the biggest enemy of the regular investor is their own emotions, and especially right now when we're in this volatile environment, if you have one of those days, if it panics you out, in most cases, that's just a recipe over time for selling at the wrong time. And it's sort of, a way for almost guaranteeing yourself to lock in losses if you let your emotions draw on you. But anyways, I'll let them pick
Adam,
up.
I'll just underscore that by saying the biggest enemy of some of the most seasoned professional investors is their own emotions as well, too. It's not just limited to retail investors.
Okay, well said. All right, well, look, a couple of questions for you around these. And why don't we start with volatility for a second? There are some ways to invest in volatility, although VXX was an ETF that allowed people to do that basically just got closed a couple of days ago. Do you recommend that people look at adding volatility components to their portfolio right now, or not for some of these dangers that you just mentioned? Like
I would say on the day we're recording, I would probably, unless you are seasoned and have experience trading volatility instruments, stay away from them, because you're talking about investing in volatility instruments when volatility is the second highest in 13 years. The reason I say that, of course, we're never going to match the volatility we had in March of 2020. That was an all-time volatility when we had the pandemic panic in the market. But after that, you got to go back. This is volatility that we saw similar to the financial crisis of 2007 to 2009. As you mentioned, VXX is halting trading. It's having problems. It's decoupling from its underlying net asset value, which is an indication of how difficult it is to trade volatility products. If you've got experience trading these products, that's one thing. If you're new to the game, go pick a shit coin. You might be better off doing that than playing these right now.
Okay, and that's really good advice. Not to go buy a shit coin, but to stay away from these things if you're not experienced. In sort of a similar vein, you talked about that we typically see this type of volatility more in bear markets as they really get going than we see in bull markets. For quarters now, people have asked the question, hey, is now the time to short the market? Is now the time to short the market? Now, of course, the market's down 12% or so for the year. But given where you think we are right now, does a short positioning make any sense here or not?
Well, yeah, in general, a short position makes sense. That I still think that ultimately the low of the year is not in. That would have been Monday. The week we're recording was the low close of the year. But that said, this is the problem with short the market. The market, when you have a bear market and prices go down, you have these violent swingbacks that make it really difficult to stomach staying short the market, because it just, God, look at this, how much money I made. It's all gone. Oh, look at this, I got it all back. It's all gone. And so it really chases everybody out. So in general, if you would ask position for a declining market, it can come of one of two ways. Underweight your risk, so that if the market sells off, you don't lose as much. And I would argue a good strategy would be, if you're listening to this call and it's all in you and you're worried, then you've got too much risk, and you should basically de-risk yourself. What is the worst that could happen in a de-risking of yourself? You lose an opportunity in the middle of World War III, in the middle of a lockdown in China, in the middle of the highest inflation rate in 40 years. Yeah, I should have been loading up on risk at that point. If that's not your call, then de-risk and ride this out and wait for a time that you better understand the market. If you want to go the next step and be even more aggressive and short the market, there are inverse ETFs that you could use to do that in a number of ways. It's kind of like the commodity call. It's not going to be a straight line. It might wind up being a winner in the long run, and I think it will be, but it's going to be a wild ride to get there, as we've been seeing just in the last couple of weeks.
All right. So on that vein, you mentioned this maybe not being a bad time to start putting money into short-term T-bills, basically. They haven't paid you anything for a long time, and they don't pay you that much right now, but in a rising interest environment, they'll start paying you more as time goes on, and they'll start paying you more certainly than your bank will in most cases. So you didn't use the word cash, but I'm going to put words in your mouth and say that cash is not a bad way to de-risk right now. And I just want to get your reaction to a tweet that I put out earlier today, where I said, despite today's inflation, cash's day in the sun may finally be nigh. We've got recession risk increasing, which the inverting yield curves are suggesting. We've got the rising cost of capital. It might tank the markets, in the real estate market too. And the US dollar might strengthen, if you follow Brent Johnson's dollar milkshake theory.
Right.
So having dry powder to deploy, should these things happen, will be a big advantage in the future. What do you think about that?
I think you're right. What advantage does cash have for you? Is that whatever hits the fan or doesn't hit the fan, you don't lose any money if you've done it right. And if things hit the fan, you can buy a lot more of it at lower prices than you can now. That's the benefit of cash. Is it's a place where you just go and you say, whatever happens or doesn't, whatever happens or how ugly things get, I know my net worth tomorrow is going to be the same as it is today, and I don't have to worry about playing it. Maybe you get it right and you're long the right energy companies or something like that, and they go stratospheric, but that's going to be a hard ride. So yeah, cash is a great place to wait it out until you've got a better feel for the type of environment we're in. Look, even if we're right, even if I'm wrong and the market goes up, it's still going to be a wild ride on the way up. At least, we're still having these 2% days, and this is not normal that you would see. Certainly, we all remember last year when the market went up a lot. We didn't see any days like this last year. because that's usually what you see in a rising trend. These kind of days are not what you see in a rising trend. So yeah, cash is a good place to hide. Now, of course, we're assuming when you say cash that you're hiding in a government backed treasury bill type backed investment, and that you don't wind up in some P2 prom, junk rated commercial paper that owns a bunch of Chinese companies or something like that. That's called a cash fund as well too. So keep, if the cash fund has a gigantic yield, it might not be the safety that you think you're getting if it has some kind of a gigantic yield.
All right, awesome answer. Well, Jim, look, I could continue flying with you with this altitude all day long, but I got to land the plane here time-wise. Two quick questions about assets that you briefly mentioned, both Bitcoin and gold. Why don't we start with gold? Tons of commodities their prices have gone bonkers, right? We've seen these incredible price spikes, and you referenced a bunch of them before. Gold hasn't responded as crazily as many assets like nickel or wheat or oil, but it did manage to get up a week ago to an intraday all-time high, and it's cooled off a little bit since then, but it's kind of hanging in there. I guess my question is you and I have talked about gold a bit in the past, and I believe in general you're sort of a fan of its long-term macro outlook here. But has anything that's happened recently either A, changed your outlook, and B, beyond commodities being more volatile in the short term, do you think all the things we talked about, the recession risk and everything we think the Fed's going to do, is that gold positive or negative in your eye?
Gold has been the single most frustrating thing that I've seen in a long time. And the reason I say that is everything a gold investor invests for is happening right now. Inflation, world war, political strife, it's all happening. And what does gold do? It gives you one day over $2,000 an ounce is all it really winds up doing. So why isn't gold going? It should be going. It should look like the wheat chart, or it should look like the crude oil chart, but it's not. And I think the best answer I could give you to that extreme frustration with gold is twofold. One, which we'll talk about in a second, I think some of it's the money that would go into it's been sucked into cryptocurrencies as an alternative. So, people are not really looking at gold. And two, I think that gold itself has undone itself. And what I mean by that, why do you invest in gold? Because if you're worried about the financial system because of world war, inflation, or political strife, or anything like that, you want to get your money out of the financial system. Well, you can't really do that. Maybe cryptos is something new, but prior to that, gold was the closest way you could do it. But what did we wind up doing with gold over the last generation is we financialized it, right? We have ETFs on it, and we have derivatives on it, and futures on it and stuff. So what happens to gold if the financial system runs into severe trouble? Go back and look at 2008. It collapsed in price because all of a sudden it's like, yes, I put myself in gold because I was worried about the financial system. How'd you do that? I bought GLD. Well, that's not going to do you any good when the New York Stock Exchange can't open. You got to own physical gold. Oh, that's too hard and stuff like that. That's where I think the problem comes in with gold. So it is like I said, it's frustrating because, boy, I don't want to be Peter Schiff today because I love Peter. I really do. But man, Peter, you got every story you've ever hoped for in the history of gold working for you. And it's still not above $2,000 an ounce. And so it's got to be real. I don't know what the next great gold story is. And hopefully it doesn't have to start with the word thermonuclear, because short of that, I don't know what's going to get the price of gold moving. I'm not bearish on it. I want to emphasize, I'm just extremely frustrated with it. Maybe it's a delayed reaction and maybe it would continue to go, but it has been very disappointing that it hasn't moved so far.
All right. Well, I think almost everybody in this viewing audience will agree with you. There's a lot of folks that own gold. We talk about it a lot. I appreciate you giving voice to their frustration here. And I don't want to dig into it because I've taken so much of your time already. But one of the things that gives me hope, just on the technical side, is you have that long, kind of decade-long cup and handle formation that gold has been tracing out, and pretty much with the intraday all-time high the other week. We kind of, it looks like we've finished the handle now. So one can have the hope, at least technically, that maybe gold starts having the type of performance that many of us think it should, given all those lists of kind of perfect storm of things that would be gold positive that are going on right now. All right,
I'll just reiterate real quick. Like I said, I don't dislike it. I just find it to be very disappointing that everything should be working for it and it's not moving. And maybe it's just I'm early, and just be a little bit more patient. And I'm hoping that's the case, and it will have its day come very soon.
Well, hopefully, and Jim, I don't know how long you've been a gold follower, and I'm assuming a long time, but I know that myself and a lot of folks watching this, we've looked at what's happened after the past 10 years as the central banks around the world have increased their balance sheets by trillions and trillions and trillions of dollars, and yet gold really hadn't moved all that much. So, we've sort of lived with this frustration for a long time. It's particularly exacerbating right now because you said all the things that we ever could have, I don't want to say wished for, but ever could have said, look, this is really what's going to finally, slingshot gold to where we think it should go. Still not happening yet.
Let me
so
just
sharing your frustration.
Since you're in the gold, you'll appreciate this. My first real purchase of gold was when Ian McCavity talked me into buying Central Fund to Canada. So that's how far back I go with gold.
Wow.
If you know who he is and how far back that goes back to the 80s, right there.
All right. So you've been a long suffering, frustrated guy as well. All right. So anyways, cryptos might be eating some of gold's lunch. Interesting that there was, I think, a long debate over the past couple of years as to whether cryptos were a risk on or risk off asset. I think that debate has largely ended now. They've traded much more like a risk on asset as the markets have gotten more and more worried. That said, it looks like they found a bottom. But anyways, I know this is a space you've followed more closely than the average analyst. What are your thoughts right now on crypto?
You're right. It has acted like a risk-on asset. And the simple reason it has is that there's been a huge institutional adoption, right? Big pension funds, mutual funds, hedge funds have come into the crypto space. What do they do when they come into the crypto space? They're very simple. They open a Coinbase account and they buy some Bitcoin. And then they say, okay, well, now who's going to oversee this investment over in our professional investment shop? I'll have the technology analyst watch this because it's a technology. So it trades a lot like ARC fund. It goes up and down with the market, just with more volatility. Why don't they do more than that? Because you could stake it and lend it and, borrow against it and put it in a liquidity pool. If you don't know what I'm saying, there's a lot of other things you could do than just buy it, hold it in an account. What's holding them back is the regulatory uncertainty about a lot of this stuff. Maybe we're going to get some clarity on that. But in general, I do want to make one other comment about cryptocurrencies. And a lot of people in this space are making it, and I agree with this following. Forget the Larry David commercial in the Super Bowl. What was really even more positive for crypto was what happened with the Emergencies Act in Canada and what we did with Russia. It really drove home the point that everybody who's listening to this call, I'll say this bluntly to get my point across, all of us, our net worths are zero. All of us, our net worths are held by financial institutions. As long as we stay in the good graces of those financial institutions, we don't protest our government by honking our horn too much because they'll say Emergencies Act and take our money away from us, or we don't start a war against another country that the rest of the world doesn't like. They'll take their money, they'll take our reserves or our money away from us. And look, maybe one or both of those was justified as a move, and I'm not arguing that. But by opening that Pandora's box and saying now, based on your behavior as a country or an individual, we can sanction you by taking your net worth away, people are going to look for an alternative to protect themselves from that. And cryptocurrencies and cold storage wallets are starting to really get discussed in that realm. The way to come about that is to have the government show more rules that they can't do exactly that. But instead, they're doing the opposite. They're making it easier all the time to sanction people that do unapproved behaviors by freezing their bank accounts, taking their money away from them, and the like. And I'll give you one quick example. Well, that was Canada and that was a protest, and this was Russia with Ukraine, and those are one-off examples. A bunch of people gave money to the Canadian truckers through the American company GoFundMe. The Canadian government asked GoFundMe, and GoFundMe took $9 million in their account. This was early February, froze that money, said, I'm not going to tell you how to request a refund. You have to figure it out. But in fairness, the directions are on our website. Go figure out how to give us a refund. Oh, by the way, if you don't, we GoFundMe will give the money away to a charity of our choice. That's theft. That's outright theft is what that is. And so these kind of examples. Now, the addendum to that story is after social media outrage, GoFundMe then actively refunded all the money to those 9 million people. But the point is the damage was done. Man, they could take my money away from me just like that and just give it away to their own charity because they said I gave it to an organization we don't like. All of this is getting crypto a second look by a lot of people, or a first look by a lot of people, because of the inherent safety that it is my money, it is in my account, it can't be hacked, it can't be taken away from me because I said something that somebody in power disapproved of.
That is a hugely important point. I'm so glad you brought it up. I'd love to delve more deeply into that, but Jim, I think that's its own full interview right there. And I got to land this plane like I promised it would, but I am really glad that you drilled into that. And for folks watching, Jim just sort of really made the case that we're seeing growing evidence that it really makes a lot of sense to hold at least a portion of your wealth in a form where it cannot easily be taken by another party arbitrarily. And crypto is a way to do that. Precious metals, particularly in their physical form that you hold yourself, are a way to do that. And two resources that I've mentioned in this program before, but I'll mention them here real quickly. Go to wealthion.com/crypto, especially if you don't know too much about the crypto space. I interviewed Stephen McBride from Risk Hedge a few months back. If you haven't watched that video, go watch it. But he is at that URL I just provided. He provides, it's like a 40-page guide into how to invest in cryptocurrency. So it's a really good onboarding education vehicle for somebody who hasn't perhaps bought their first coin or token yet. And then if you want to learn how to buy precious metals, go to wealthion.com/how to buy. And I've got a really detailed primer there on all the options that you can consider. All right, Jim, this has just been yet another phenomenal conversation. You're definitely one of my favorite people to interview. It's always a great and highly insightful time. Thanks so much. For folks that want to follow your work from here, learn more about you, where should they go?
Twitter @Bianco Research, Jim Bianco on LinkedIn, or our website, biancoresearch.com. We offer a research product primarily tailored for institutional investors.
Okay. And I can say that your Twitter feed is just a delight to read. It's both a combination of a lot of great timely insights on what's going on in the market, but it's got your own little brand of humor with a little sarcastic edge on it. So I'm a avid follower, as you can tell, and I'm pretty sure you're going to pick a few more up after this interview. And I'll put those URLs up on the screen when we edit this. Well, thanks so much, Jim. I'll let you get back to all the action going on, both in the markets and in your March Madness bracket.
Okay, thank you.
All right. Well, now's the time on the program where we bring in the lead partners of New Harbor Financial, one of Wealthion's endorsed financial advisory partners, to react to what Jim just said, but also to make it actionable for regular investors like those of you watching. You may see that I'm in a different location than normal here. I am on vacation this week, but still wanted you guys to have the full experience with this interview. So let's just jump right in. John. Jim is one of my favorite guys to interview, as I'm sure came across pretty clearly in that interview. What do you think about Jim's overall macro views as well as his particular investment recommendations?
Yeah, I think Adam, he talked about what is on everybody's minds. I think, inflation, front and center inflation, not only the headline inflation numbers and what that likely means for a dramatic shift in monetary policy regime, but also what it likely means or what it likely should mean for the kinds of asset allocation decisions right here and now that might be prudent. I think he like us, I think, basically believes the market is not even close to really pricing in the inflation problem, at least here in the short term, that could quickly become a disinflation or a recessionary type or even stagflation type environment. But he talked about the Fed kind of announcing their forecast for 7 rate hikes this year. Well, most market strategists really only thinking more like 4, basically on the time-honored rock solid belief system that has been burned into everybody's psyche over the last decade, that the Fed would never do anything bad to upset markets, and therefore 4 is all they can do before they have to reverse course out of fear of upsetting markets. He, like we, and I think many other strategists are starting to say, they've got a real problem on their hands with inflation, and they're likely to keep going beyond the market's belief of only 4 until something really breaks. And they're now having to worry about the masses, not the people that own assets, but the masses of folks who really are struggling with really profound price increases. So the inflation trade he talked about, hard assets, real things. We have been preaching that we think those are and will remain a very important part of a portfolio. But he also talked about short-term treasury bills as not being an inflation hedge, but really a safety place. And in a rising interest rate environment, at least they're likely to get a steady uptick in coupon yields from what was essentially 0 to something that's becoming incrementally more attractive. But the real value of, we'll call it cash, short-term treasuries and things like that, are their ability to be safe, but also be converted and deployed really quickly and really easily into other assets that will likely reprice in this paradigm shift.
All right. Yeah, good summary there. And I'm glad you talked about the T-bills, the short-term T-bills. And you're reminding me that we had talked maybe a month or 2 ago about how people can actually purchase T-bills themselves directly through Treasury Direct. And I polled the audience and asked folks if they wanted me to do a little explainer video walking folks through how to do that. Haven't done that yet, but now that rates are beginning to, or yields are beginning to go back up for those T-bills, maybe it's time for me to do that pretty soon. All right, Mike, anything you want to add to what John said around Jim's perspective before we start talking about what the markets have done this week?
Yeah, there's some surprising tidbits in there. I think John covered it really well, but clearly the thread throughout the whole talk is that inflation is a major concern for the first time in a long time. The CPI printed 7.9%. Everyone can kind of see inflation creeping into everyday life, and it's a real concern. And he thinks that the market's underestimating Powell's resolve and the rate at which Powell will raise rates or try to fight inflation. That's probably right. And 2 things that I thought were interesting that many people have heard before that just kind of keeps sinking in every time I heard it. Policy mistake. You hear on the news, the financial news, that, maybe the Fed's going to make a policy mistake if they raise rates too fast. And he points out the policy mistake is not now. The policy mistake was made last year when the Fed called inflation transitory. And they've been trying to really create inflation for a long, long time. And then when it started to show up, they called it transitory. Now they're probably too late. And so, that's one thing that struck me. The other thing, just bringing the concept of inflation down to everyday life, when Jim said that the average person made more in the increase of their home value last year than they made working. I mean, I'm not sure if that's ever happened before in history. And that really just speaks towards how, this housing market is, in our view, in a bubble, just like the stock market to some extent, and how it's pricing out really the lower 40 or 50% of income earners and wealth holders in this country. And it's likely to create social problems down the road. So those are the only additional thoughts I have.
All right. Well, I'm glad you brought up housing there because, mathematically, the Fed has just come out and said, hey, look, we're going to hike interest rates another 6 to 7 times in this year alone, right? And mathematically, housing prices should come down as mortgage rates go up. And mortgage rates have started to rise. They've actually risen fairly substantially compared to last August. And so at some point in this trajectory, provided the Fed does start delivering on those rate hikes, you're going to start having a lot of downward pricing pressure on the housing market, which will initially cool it off, but then should actually start bringing prices down at some point in time. And as Jim and I talked about, if we end up going into recession, if there tends to be a market crash that goes along with it, all those are factors that generally tend to pull housing prices down as well. So I think we haven't talked as much about this in past videos here, but I think the specter of a housing market correction is beginning to loom larger than it has in the past. And we could very well be seeing kind of a perfect storm where people see their portfolios go down, maybe layoffs start happening, worst case scenario, maybe they lose their job, and having housing prices come down at the same time. John, I see you nodding a little bit there though, but is that a potential future that we should at least be devoting some, mental capacity to preparing for here?
I think it is, Adam, and it's not through any kind of death wish or anything like that. I think it's just a simple openness to changes and trends. And it's really helpful to kind of zoom out and look at a longer term perspective to even put that into reasonable clarity. Look at where interest rates have been over the last 40 years. They've essentially gone nowhere but down. And now we're in the first time in 40 years really having, as Jim pointed out, a Fed that needs to worry about inflation, right? So this 4-decade period of easy and lowering interest rates is likely turning on us. Maybe it can't go back up to where we were in the interest rates in the late 70s, early 80s, because things could really break. But to think that like the last decade where both stocks and bonds had massive returns, and even over the last 4 decades, to think that those things going up in tandem can't come down in tandem, I think this would be very naive. And the reason they both went up in tandem is the very reason that they will likely go down in tandem to some degree. It's a massive regime change in debt expansion and interest rate reductions and all that kind of stuff that has been more or less a one-way trend for the last several decades and likely turning around in trend.
Yeah, and I think what's important here is, Jim really was saying, look, I think the Fed is more committed to fighting inflation than the market realizes here right now, right? And so, the warning flag that Jim is waving here is that, like, hey, folks, the market might get hit a lot more than current participants are ready for right now because they don't really believe the Fed's serious here. They don't think the Fed can hike very much before it gets pressured to pivot, right? Hey, time will tell. But Jim seems to be pretty concerned that, like, hey, I don't think folks get it. The Fed has got to bring inflation under control here. It's going to be pretty darn aggressive. And, a mantra that has proven very accurate over the past 12 years or so has been, don't fight the Fed, right? The people who were just wantonly long and said, hey, look, the Fed wants this market to go higher. It's bringing rates down. It's going to step in and intervene whenever things even get mildly rocky. They were proven right. And they rode that old saying, don't fight the Fed, right? Well, now potentially the Fed may have changed tune. And the Fed is saying, I am bringing rates higher here no matter what happens. And I think there's a lot of people out there, not just in the markets, but going back to housing, who have gotten so used to housing being such a stable, steady, capital appreciator that it's maybe a future that a lot of people can't imagine. And you guys talk to people all day long, right? And I think a lot of people consider their house as their biggest asset or one of their biggest assets. That's why I'm bringing this up here, because if indeed we end up having a housing correction and one larger than many average Americans, are imagining right now, I could really catch a lot of people flat-footed, especially in this market now where, especially a lot of the boomers. One of the things that's been supporting the housing market is that as boomers have downsized, they haven't sold their prior homes because they keep appreciating. And so they rent them out or they Airbnb them or whatever, right? So that's just, more exposure to this asset class than they used to have. Mike, love to get your quick thoughts on this.
Yeah, it used to be. I mean, I don't really have statistics on this, but it used to be that your home was by far your largest asset. But we live in such a time of just bubble finance, for lack of a better way to put it. A lot of the people that we're seeing, the home isn't the largest asset anymore. There's been such massive appreciation of financial assets. A lot of times the financial accounts or the retirement accounts are much larger. And there's just such a sense of overconfidence and almost hubris out there in the marketplace that this is just a one-way street nonstop. And like you said, people are very reluctant to sell their homes, and because why sell them when they only go up? And when you can collect rent on them, and so there'll always be time later to do so, is the belief. And we've just had a monster bull market, like John talked about, for literally 4 decades in both stocks and bonds. And the last few years I really think, have been an extreme example of just how distorted things can get. And we are constantly just telling people or trying to counsel them to simplify their life, to sell that house instead of rent it out, unless it's a very strategic reason not to, and to reduce exposure to risk assets, because the party is likely ending. There's a lot of hubris in the marketplace out there that, oh yeah, Powell may be tightening, but he's probably not going to crash the market, is what most people seem to think. Oh, and even if he does, don't worry, there'll be a Powell pivot and that'll be just a dip to buy. What if the math is actually right this time about the valuations being more extreme than ever? What if the hubris of market participants and the central bank itself has gone too far? And, this time, even if there is a pivot, which there almost certainly will be, what if the markets continue to fall apart like they probably should, based on the mathematical valuations that we're seeing? So it's quite a dangerous game to play, to try to assume what's going to happen, to assume first what the Fed's going to do, and then secondly, assume that the future is going to look just like the past and that we're going to bounce back vertically from there. Maybe that'll be the case. It's happened way too many times, a lot more than I would have thought. But, we would still counsel people to simplify their lives, to raise buying power, raise cash, and expect the unexpected.
Okay. All right, great. Well, I'm just hammering on the housing part because, one, I don't think we have talked enough about it, and that's more on me in terms of focus of past interviews. But I do plan to bring on, to the extent folks are interested to hear, and let me know in the comments section if you are, a few more real estate experts to kind of give us real-time feedback on what's going on in the markets. I had Ivy Zellman on back in January, and she said that she was becoming cautious. I think things have changed materially since then, with the Fed getting really specific about how many interest rate hikes it's going to do, and it hiked rates the other week. So they're now showing that they do kind of mean business. But, I think we've talked on this program. It's like the top 10% of households own 90% of all financial wealth, right? But it's something like 60-something% of all Americans own a house. So if the real estate market gets hit, it impacts a lot more people than what happens in the financial markets. All right. Well, speaking of the financial markets, John, let me come to you and let's talk about what the markets have done since we last talked last week. I'm not really following the tape that closely. I'm trying to enjoy vacation here in this wonderful paradise. By the way, folks, I'm in Colombia, Cartagena, Colombia here, which is a phenomenal place. Happy to talk more about it at some point if folks want to know what a great country this is. But the little bit that I've been seeing has been a lot of market participants scratching their heads and saying, my God, this market's just being Teflon, at the moment here, where, again, Powell came out, flexed his muscles, and the market said, not too worried about that. And it just, continued going higher. So what are you seeing here, John?
Yeah, well, you'd have to be watching it really, really closely, Adam, to really appreciate what's going on. And I don't recall exactly when you recorded the video with Jim. We're doing this with some passage of a handful of days, I think. But he had noted when you recorded with him that the market was down maybe 12% on the year. As of yesterday, here we are recording this on Thursday, the 24th of March. Yesterday, the S&P was down 6.5% or so. So there's been a face-ripping rally in recent days. Really kind of timed with the Fed meeting last week, and it's kind of been more or less straight up, but quite volatile days, pretty wide ranges. And, this is all kind of stuff that's pretty typical. In fact, you and Jim talked about it. When you start to get volatile days like these, very whipsawy wide ranges, they tend to be kind of more prevalent in early bear markets or ending bear markets than bull markets. So, time will tell, of course, but this is pretty classic or expected kind of behavior in a major topping turning point. Even the face ripping rallies to the upside, like we've just seen, those are very, very, very common in early stages of a true bear market. So volatility, I think, is the key word that we've seen, certainly in the stock market. Interest rates have risen pretty dramatically. Commodities have been remarkably strong, even though they had a very sizable pullback in recent days and weeks. They remain very strongly bid, especially things like basic materials and some of the base metals and even precious metals, even though there's been pulled back there. But yeah, that's volatility, I think, is the word.
Yeah, it's funny. I just checked some of the stocks I follow for the first time in a week. A lot of commodity producers in there, and was very pleasantly surprised to see how strongly many of them have rebounded since just the past week. John, let me ask you this, and then Mike will come to you. So, John, it seems like the key question here is, are we in a bear market rally, right? Which you said, hey, this what we're seeing right now is actually fairly commonplace in a market that's rolling over, right? As you have kind of the initial correction, then you have a sharp rally, but then that's then followed by further downward. So are we in a bear market rally here that's eventually going to reverse, or has the market digested everything the Fed's going to do, and it's coming up for reasons to just continuing power ahead, continuing the bull market run of the past many years? Not necessarily asking you to make that call right now, but if you can just share, what will you be looking closely at to try to divine the answer to that question?
Well, we're not always super macroists here, but the inverted yield curve is certainly a divergence from the idea of we're back to the races to a bull market. And in fact, Jim, and you talked about that. Inverted yield curve or flattening to inverted yield curve is usually a very strong predictor of a slowing economy, and even worse, recession. And Jim rightly pointed out that this is the first time ever he thinks, and I have no basis to challenge it, that this kind of inversion has happened essentially one hike into the beginning of a tightening cycle. Prior points of breakage in tightening cycles, even in 2018, I think it was, it took like 7 or 8 hikes, I think, before. Point being is that the recession flashes seem to be already coming into the fold here, even this early on in the rate increasing. That's why the market strategists think, oh, they won't possibly follow through, but the inflation numbers aren't buying it. Their break-even yields on 10-year treasuries, which is a measure of the implied future inflation, first time ever exceeded 3% today. You can go back and argue that it was higher in the 70s, just the way they calculate it, but that's a big deal. That's a big deal, and the stock market certainly doesn't, in our opinion, have that priced in.
Okay, great. And Mike, I want to start to wrap things up here with a quick recap of gold, because it looks like gold has found some footing again, whatnot. And I know we have a lot of people here who are big followers of gold. But very quickly, anything to add on to John's comments about, how to tell whether this is indeed a bear market rally or not?
Not really, Adam. The comments that John had about turbulence there were exactly right. I mean, I'm just looking at the market now. We closed up 60 S&P points. We closed down like 50 yesterday. These are big moves. We're talking over a percent plus in either direction, opposite directions in day after day. So who knows? The volatility, though, is a bad sign generally, particularly with valuations where they are. And of course, as we talked about during this whole interview, with the Fed tightening in the next couple of meetings, it's coming right up. So really not much there. I do have a couple comments about gold. I don't know if you had a specific question there on that, though.
Mostly, I just think, last week you guys were saying, hey, we're seeing a retracement in gold. We think this is healthy and natural given how quickly and how far gold had moved. we're not worried. I think this week provides a little bit of validation of what you guys said. Gold's now, I think last time I just checked, it was about 1963, 64, something like that now. But I wanted to give you an opportunity to, I don't want to put words in your mouth. So how are you guys feeling about it this week?
Yeah, like we've said other times before, gold has been in this big triangle consolidation that topped out in August of 20, and it felt like it was going forever sideways for a year and a half, and it finally broke out a few weeks ago. Quickly went to 2100 and had a very fast drop down to 1900, and I think a lot of people said, look, gold's putting in a double top again. Forget about it. It got ahead of itself. It really didn't
crack what's below 1900 for a little bit there.
Just barely, and it bounced pretty fast. Yeah. And, it looked like a double top, a failed pattern again. And, we didn't think that you should be very quick to rule out gold. Gold has kind of been the forgotten asset for a long time throughout this whole bubble of Bitcoin and meme stocks and NFTs and the S&P and tech stocks and FANG. Everything has been taken off except for gold. And gold has quietly been plodding along and tracing out this bullish triangle. Well, it broke out a few weeks ago and it's been pretty whippy, but it seems very persistent to the upside. It's done no damage technically to the downside. And it's really just consolidating in this tight $200 range. It doesn't feel that tight for people that hold it. It feels like these moves are pretty gut wrenching, but if you step back and look at the charts, it's actually consolidating at a high level near the high. And, as Jim talked about in his piece, the inflation trade or assets that should do well during inflation are ones that you want to have exposure to. And gold is giving all the technical reasons to own it or to buy it if you don't already own it here. So we're very positive on it.
Great. I don't know if you guys got a chance to watch it, but I released a video a couple days ago with Jeff Clark, goldsilver.com's precious metals mining analyst. We were doing an update on his GDX Jeff portfolio of mining shares. Jeff had noted that, hey, along with gold's retracement, we saw some of that in some of the mining companies. But he wasn't worried at all. Thinks both gold and the mining companies are setting the stage for much higher prices ahead. And, the mining companies I just looked at them briefly before hopping on here with you guys. They've had real strong performances since last week. I know they're still one of your guys' largest positions. And maybe I should ask, because I checked in a couple of weeks ago with you when the market was down, over 12%. Back then, you guys said, hey, the market's down that amount, 12%-ish around. Your guys' core model portfolio was a little bit positive for the year, which was great. That's what we sort of look to you guys for with all your risk management that's going on. Is your portfolio still performing pretty well, especially given how the mining stocks are recovering here? John, let's go with whoever wants to take that.
Yeah, our portfolio, Adam, still is performed pretty well. Positive return, nothing earth-shattering. Remember, we're still very conservatively postured. We are focused primarily on capital preservation at the moment. So I would say that in general, I think that our portfolios may have increased a tiny bit over the last couple of weeks, but we are in the low single-digit returns year to date, and we are not participating with the same volatility that the broad stock market is. Nor do we think that the decline that we've seen recently was enough to really, do much of buying the dip. Now, it's altogether possible that the market could go vertical from here. You've got guests on the program that talk about a melt up. David Hunter has said that pretty repeatedly, and it's absolutely positively possible. I don't think it's probable, but it's possible. The market isn't just incredibly resilient here. Today we just reversed a decline yesterday and closed right on the top tick. So that's about all I have to say. I don't think it's worth playing the game to try to play a melt up or a further move higher from here, because valuations are just insane and have been for a few years. And so I don't know, we're going to keep playing it the same way that we have been. We have done a few moves recently. I think we mentioned last week that we added some long-term bonds for short-term trade, and even that position is hedged, but we're focused squarely on capital preservation and maybe making some little returns along the way. But the biggest thing we're concerned with is downside capture. We don't really want to participate much in a downside move.
All right, great, Mike. Guys, I hate to rush things here, but got to get back out to the family. So John, I'll let you have the last word here. With all the folks that you guys are talking to these days, you have a real sense of what's top of mind in terms of folks' hopes, fears, needs, desires, etc. Any bit of parting advice for folks, again, who are trying to navigate this very confusing time?
Yeah, it's important to be diligent and vigilant. That's what we think our job is for clients. But it's also important to live your life. Adam, you're there on vacation with your family. Folks should be doing that. This shouldn't, the uncertainty and volatility shouldn't keep folks awake at night. Being prepared and positioned is really the right thing you need to do. And don't really fret it otherwise. There's a lot of scary stuff going on in the world right now. And, remember to take time out and be at peace.
All right, that's good, calming perspective, John. As a reminder for everybody, as always, we at Wealthion highly recommend that to navigate these challenging times that you work under the guidance of a professional financial advisor who understands the risks and the trends and the pitfalls and the opportunities that Jim and I talked about and that Mike, John, and I just talked about here. If you have a good one, great, stick with them. If you don't, or you'd like a second opinion of one who does, then consider talking to one of Wealthion's endorsed financial advisors for free. They give a free 30-minute consultation where they'll dive deep with you, understand your personal situation, and then give you their honest recommendations. If you want to figure out how to do that, stick around to the end of the video. We tell you how to do that. It's coming up in just a few seconds. John and Mike and their firm obviously are a premier among that offering there. All right, and if you enjoyed this interview with Jim Bianco and want to see more great guest interviews like him, please do me a favor, support this channel by hitting the like button and then clicking on the subscribe button below. I got a note here that we are almost at 100,000 subscribers for this Wealthion channel. We started almost a year ago. I'm trying to hit the 100,000 mark before we get to our 1-year anniversary. So if you haven't subscribed yet, please do me a favor and do hit that subscribe button to help us hit that goal. Otherwise, whatever happens from here, we will be tracking it all together here on this program. John and Mike, thanks so much for joining me, guys. I'll see you next week. Everybody else, thanks for watching.
We will see you soon, Adam. Thank you very much.
Enjoy your vacation, Adam. We'll see you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. but for regulatory reasons, they aren't able to take on non-US clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.